What is up, traders? Hope everybody's doing well. Today's lecture is going to be about SMTs, what they are, how to spot them, and how do we use them in our trading. So, what is an SMT? An SMT, first of all, occurs between two correlating pairs. So, if you're trading futures, which I am predominantly trading futures right now, it is usually between the NASDAQ and ES, right? NQ and ES. So it happens between correlating pairs. If you're trading Forex, it is usually between something like EU and GU, EUR USD and JV USD. So it happens, and SMT happens with correlating pairs. Okay, pairs that usually move in sync together, right? So what it is basically when one of the two correlating pairs, since they usually move in sync, right? One makes a high, the other one makes a high, the other makes a low, the other one makes a low. They move in sync. It happens when they desync, right? What do I mean? For example, right here, this is a bullish SMT. We have one of them making a lower low right here on Q. Then if we go to ES on the left, right here, ES, we have ES making a higher low. So now they are decoupled. They should be like ES now should have made a lower low just like NQ, but it didn't. It made a higher low. So now they are decoupled. Now this is an SMT. We mark it as an SMT. What does this mean? For example, if we're looking for a long opportunity or a short opportunity in general, an SMT just gives us that extra confidence in the trade where, let's say we're going up, or in this case, we're going down, right? The market is like, it's moving down. It's moving down here, right? And we're looking to take longs on one of these pairs. When an SMT occurs, it just gives us that extra confidence that the trend now is going to shift because one is not agreeing with the other. They were going down. Both of them were going down. So at this point right here, both of them were going down. But then at this point, ES was like, no, I want to change my direction. Let's put it that way, right? So now instead of both of them going down, now you have one going down and one going up. So now that's a first sign of the market switching in direction, right? So if we're looking to enter longs on either NQ or ES, it just gives us that extra confidence that, okay, if we apply this SMT with other factors that we've learned, then it's higher probability, let's put it like that, right? So it just gives us that extra confidence that, okay, the market was going in sync in one direction. Now it's not in sync, and it shows that it might want to switch in direction. So if I'm looking to enter longs and the market was dropping, it just gives me that extra confidence that, yes, I'm probably now on side. Get what I mean? Let's go and look for another SMT. All right, example number 2. This is a bearish SMT. As we can see here, the market was in sync, pushing up, making higher highs and higher lows together. And then at one point, you have ES and NQ disagreeing. You have one of them saying, okay, we were moving in sync together up. Now NQ doesn't want to move up, it wants to go down. But ES says, I want to continue to go up. Now, instead of having two going up, you have one going up and one going down. So for example, if you were looking for a short idea, this would be a first sign, right? Okay, I'm now anticipating a reversal because they were synced, now they're desynced. They were both going up and agreeing in movement. Now they're disagreeing. So now the trend is weaker. So now I have an idea, or I have a first sign that, okay, if I'm looking for shorts, this might be the time. And we can see here how the trend did shift for a while before maybe it continued its uptrend. No, just completely dropped from there, right? So an SMT, again, it's a first sign of a change in the trend. Now that change can be magnificent like this, or it can be just short-lived, and that's enough for you to take a trade, right? So I'm going to take you guys for the another third example. It's going to be the final example here on SMTs. All right, third example. Now this example, I'm going to go at it from a kind of a different perspective. Let's assume that you took shorts here, right? Let's assume that you took shorts on NQ. By the way, this was a short that I took. Stop loss was above this high, you entered at this fair value gap, right? We can see here, let me show you guys. You have this is the macro, right? This is a trade that I took. Let's mark out the macro. So you have 1045 right here, 1115 right here, right? So this is the macro, cool. You have a breakup structure right here. We have a fair value gap right here. If we look, it was tapped into. If we mark it out, it was just barely tapped into. You can see that wick. Right here, you can see that wick tapped into. So I took this short. Boom, entered right there. Oops, right there. Stop loss above the fair value gap, but we're not going to have to talk about that right now. And then take profit. Initially would have been at this low. But then you look at ES. ES took this low. Right, look at the times. Look at the times. I have them marked out at the bottom. Look at the same time, the same lows. You have ES swept that low, while NQ didn't. ES closed here after sweeping it, while NQ closed here and didn't sweep it. So when I was in the trade, this would have been a first sign that we might have an SMT and price might want to reverse from here. It might not want to come down and hit my take profit. Okay, so I'm looking at ES. ES has swept it. NQ might lag and might not sweep it. So I ended up closing my position immediately. Right here. Because SMTs not only help you enter trades, but they help you exit trades. Because if I see this kind of movement, then this might be an SMT. So I'm going to sacrifice this little bit of extra profit here to maybe save my whole trade. I don't mind closing my position here instead of at this low where I initially had it, because I see some SMTs. Even if this SMT ends up not being true, like just at the moment it was kind of maybe showing me that it's an SMT, but then it just later just breaks it, no problem. But in the moment, which ended up being true, it was looking like an SMT. NQ closed here while ES closed here. See, it swept here, it wasn't swept. So SMTs not only help you enter trades, but they help you exit trades, right? So that's going to be it on SMTs. Again, to kind of put it all in, SMTs are first signs to either enter or exit trades, and they're signs that the trend wants to reverse, whether from an uptrend to a downtrend to an uptrend. They happen between coupled pairs, and they're a sign of decoupling. And when that happens, that usually tends to result in a shift in trend, either short-lived or long-lived, doesn't matter, but it does result usually, most of the time, not all the time, but most of the time, it results in a shift in trend. So if we're looking to enter a trade, SMTs can help us confirm that our trade is correct, right? Makes sense. And then if we're trying to exit a trade, SMTs are also a very good confluence to exit trades as well. So that's going to be it for this lecture. Hope you guys found this insightful. And until next time, stay safe and happy trading.